So tariffs obviously goes front and center, right? Again, we have just a lot of noise in the markets. And I'm curious, Arnim, you're talking to clients. How are you talking them through that? What are you telling them in terms of how to navigate this, to look through it, focus on the bigger picture?
Well, first of all, thanks for having me. The main point is it's not about levels. It's not about using traditional techniques and diversification. It's really about adding what the market's telling you should add, which right now is putting volatility into your portfolios, really using strategies that allow you to use this volatility on behalf of your portfolios and resiliency. There are a lot of strategists that are saying, look, take your time, don't worry. In the end, the market is going to give you that 6 to 8 and you're going to be fine. But the problem is most investors can't wait it out. And when you get a 3 to 5% downdraft with this kind of bad news or potentially fearful news, a lot of investors kind of lose confidence. And so when we talk to advisors, we're basically saying you don't have to be subject to that. You can make the ride a smoother ride. You can actually improve the resiliency of portfolios while you're doing it.
So do you just sort of go long volatility, in other words, and what are some of the best ways to do that?
Well, there are institutions that we work with that will take those kind of positions, but for example, on the fund that we manage, what we're doing is taking advantage of the range. And there's a pretty strong range trading approach that you can take to really over-defend downside and then make money as the market comes back and vol comes down. So you're really taking advantage of those oscillations. And if you look at the last 2 years, there's actually been a lot of oscillations, even in the up market. And so when the market tells you who it is, believe it. And that's what the market's been saying. And recently, with this unorthodox president, not that it's necessarily ineffective or effective, but he's unorthodox, we think there's a lot of oscillation around volatility that you can take advantage of and use for your benefit.
Arnim, when you are talking to those advisors right now and these institutions, what's top of mind for them in terms of concerns? What do you hear the most?
Well, the first thing they tell me is that they spend a lot of their time speaking to their clients, sometimes on Saturday and Sunday nights. Their clients, even with what you would...
Because they're that nervous?
Because they are nervous, and because the news, the macro news, would connote potentially bigger vol moves, would connote bigger correlation moves, and they've actually been slightly lower than the news would connote. So the markets goes down, up to, let's say, 6-7% from the peak, which is a 2 standard deviation move. It's not a 3-4 standard deviation move, but the macro environment, the geopolitical environment, they kind of connote, they have the potential for bigger moves. Listen, we're 1 tweet away from a 2 or 3% move either direction. And I think the market knows that, even though the statistics would say, hey, we're not really acting that volatile, there is a concern. And so advisors and even institutions are looking at this and saying, look, we've had great run. Do we, should we take some chips off the table? How do we handle that? And most are not prepared to use the kind of volatility tools that allow them to get that resiliency. And so those are the conversations we have with advisors, because you don't want clients to sell out in what could be, in the medium to longer term, a good market. You don't want them to lose and access to that return.
Why do you think the volatility hasn't been more?
Well, there's a lot of questions around that. There's some impact of 1-2-0 data expiry options trading. There's clearly a lot of positioning. There's also some attraction to the U.S. market that has a tendency to keep the flows. There's a lot of liquidity coming out of the post-pandemic, both fiscal and monetary priming. So the levels of liquidity are relatively high. If you look at high yield spreads, for example, they got down to about 250, 260 over. They've moved back up to about 300 over treasuries. But that's still very tight given some of the macro concerns that we have, which says to me there's just a lot of liquidity. And so that has a tendency, liquidity has a tendency to mute vol. Again, if you see some changes to the dollar, if you see some changes to the tariff and trade environment, some of that liquidity could change. And I think that connotes a bigger swings in volatility.
Here's another theme I've heard. I'm curious as a longtime market watcher to get your take. U.S. exceptionalism is dead. Your reaction to that?
I love those memes because
I thought you might, Arnim.
I love those memes because honestly, that's like saying that the dollar has lost its reserve status. U.S. exceptionalism is still very, very strong. There are incremental, dents in the armor, but the exceptionalism is still very strong. To believe that the European and the Chinese performance we've seen on a year-to-date basis is a portender of an evaporation of U.S. excellence, I think is a little overly optimistic. And in fact, the earnings don't really show it. You still have problems in China with regards to their the real fiscal stimulus that they're going to put through. Will it be enough? It's not clear to me. European earnings are running at like half of S&P projected earnings and 65% of year plus one earnings. So yes, they're lower PE, but they're also lower ROI, and they're also lower in terms of the expected earnings. So I think the case you have to make also is if the US catches a cold, it's never better for the rest of the world. And even when the US is the source of the problem, the US outperforms. So I think you have to be very careful when you look at those kind of cases, those kind of memes.
When you're looking, I mean, you are very focused on this volatility picture.
Yeah.
How long do you think it's going to last like this? Or put another way, what would decrease the volatility?
Well, we did see the better performance helped, but there's still issues around what is the Fed going to be able to get to. I think the Fed is still very core to this issue because what if wonky our star discussions around where is the equilibrium rate. My sense is that the equilibrium rate of inflation, the equilibrium rate of yields is actually slightly higher than pre-pandemic. There's a lot of reasons, it's too long to go through here, but there are a lot of reasons that legitimize slightly higher yields. So what that means is the amount that the Fed can really ease, even if they want to ease, is going to be more constrained. You see that even 2 this year is going to be kind of a difficult task. And I think Powell correctly stated, this may be transitory, but the Fed has still got a relatively high inflation target. So against a lower GDP target. So they're telling you, there's not so much easing still to play. That tells me that vol is probably going to be elevated because the levels of vol long term and the levels of yields kind of do mirror each other. If you saw a reason that inflation was going to go back to pre-pandemic levels in a credible way, I think you could see the level of vol go back down into that 8 to 12 range. But as long as that's not the case, we're thinking this 15, 16 to 20 range is a real tradable range.
Arnim, great to have you on set today.
Thank you.
Thanks for joining us.
Thank you.